Hello everyone, it's the end of April and it's time for us to look at the March real estate market data. Okay, just like our tradition, we always start with the CAR numbers, California Association of Realtors. This is the closed sales of March. So I don't know if you remember what we saw last month. So the price year over year change was the drop was slightly higher last year. Now this time, actually last month, this month we see it anywhere between 4% to like 18% versus last month we were looking at the drop was as high as like 22% for San Francisco. So things is looking better. Okay, why is that, right? So we're looking at closed sales in March, and which means these are the people who went out to look at homes and putting in offers in February. And February was a time when the rain pretty much died down in the Bay Area, right? We have a lot of rain in January. So the rain started to die down a little bit. We still have to get more sunny days in February. And yeah, so things is improving, and I bet in the coming month the number will look even better as we look at the closed sales in April. That represents people who get in contract in March, and we had pretty good weather in the Bay Area during March. So Alameda County price went down compared to last year, 14%. Contract cost at 11.7. Marine, Napa, they are doing better, 7%, 8%. San Francisco, 17.5%. So price overall went down quite a bit, and this is consistent with the trend that we have seen compared to pretty much like the peak. We're seeing on average around 15% of drop in prices. So if you are one of those who have been shopping around for home but didn't put an offer, didn't get in contract in 2022, you must be glad that you did not. So you are on average saving hundreds of thousands of dollars, at least $100,000. So if you look at Alameda County 2022, it's about $200,000 saving. And not even in lower price point Napa, you're looking at $70,000 saving. Solano, 50,000 ish, 30,000, and in San Mateo we are looking at like $400,000 saving by just waiting for 1 year. Okay, so this is all great, right? So of course when people tune in, they want to know, okay, what is the market going to look like in the future? Well, predicting the future is not exactly a science. It's not really an art. I think it's more of a witchcraft, right? No one can really get it right. If they get it right, they must possess some supernatural power. But at least I think we can do an exercise to see, to get some baseline to see what things is likely to look like. I have a little spreadsheet here that you guys can try to follow. I just built it in the last hour or so. So it starts with the year column. This is the Case-Shiller index for the Bay Area. Well, what's Case-Shiller index? If you don't know, it's a index created by 3 economists. Two of them are in the name, Case and Carl Case, and Shiller is Robert Shiller. The more famous one is Robert Shiller. He was a Nobel Prize laureate in economics in 2013. So they have this index is pretty much the most authoritative index in real estate. These numbers pertains to the Bay Area market. This specific number, there's no meaning. It's just an index. Okay, 1991 it's 71. It goes. Of course, they have numbers every year. I choose to cut off in 2019 because COVID in 2020 just threw everything out of whack. So I would use this number as more like a normal market, normal growth. Of course, nothing is really normal during this time. This is actually the end of a real estate crash in 1990. Of course, over here we have September 11th. We have another real estate crash and another recession. I picked another date here. This is more like a 1 decade from 2000, and also sort of halfway between this year 2000 and 2019. So, and of course, in 2007, 2008, we have another real estate bubble burst. So nothing is really normal, but we try to take a longer term approach to look at where things stand. And the end of year 2022, the index showed the home value is at 338. Okay, so of course we had a big increase between pre-COVID and post-COVID. Okay, so where do we go from here, right? So to predict home value, one thing you can look at is population growth, right? We have more people who need housing, therefore just prices go up. So we start with the California population. I think this is an easier number for me to get a hold of. Again, this is a really quick exercise. I put it together in the last 1 hour, so I really didn't have time to go into like pick specific counties in the Bay Area and aggregate those data. So easy ones, California. This number I picked out from the usafacts.org website, and I just picked number off from the chart. And so, and if you look at the and I use 2019 as a baseline. Okay, so this population multiples, 1 means this number divided by itself, and 2010 I take the 2019 number divided by the 2010 number. So there is a 6% growth between in this 9 years, 2019, so from 2010 to 2019. Look at this 1.06. That is also 6% growth from 2000 to 2019. So it's actually I think I have a problem here. This number is off. Okay, so let's pick the number again. 2010. 2010. 37319,550. Okay, so the 2000 number is off. 2000 number is 339,879,77. Okay, so now it looks better. From 2000 to 2019, we have a 16% growth. Okay, and from 1991 to 2019, we have a 29% population growth, and this is the basically normalized annual growth percentage. So if you look at time span from 1991 to 2019, on average about close to 1% growth per year. If you only look at this period, this 19-year period, it was 0.79%. If you look at this 2010 to 2019 is 0.62%. So the population growth is slowing down. Okay, so look at longer horizon, it was a bigger growth. If you date back further, but as we reduce the time span, we see the slower population growth. And if we just base on the population growth number, I took the lowest number here, the longest term number, and try to use that as a guide to calculate what would the Case-Shiller index be in 2022. I got to the 94, so it's not much. If you're only growing less than 1% a year, after what? This is 31 years. It would go from 71 to 94. Apparently, we are at 338. We were at 338 by the end of 2022. So population growth itself does not explain the home value growth. Okay, and if you use that number, you try to predict, okay, let's add one more year to it. Now you get to 95. So I certainly don't think our home value will go down from 338 to 95. So, okay, now what's next, right? Okay, so we have population growth. Now we also have CPI, right? Things got more expensive. Let's take a look at those numbers. I picked out the CPI number from the Department of Industrial Relations. This is the easiest one I could find. Just pick annual number from the table, put them in here, and using 2019 as the baseline. So 2019 is 100% higher than 1991. So a dollar that costs $10 in 2019 used to cost $5 in 1991. Okay, so same thing goes. If we use this number, we look at this horizon, this 28-year horizon. If CPI growth between 1991 to 2019 was about 2.5% a year. So this is California number. Okay, it's not specific to the Bay Area. It's California number, 2.5%. Between 2010 and 2019 is 2.39. Okay, again, I use the longest horizon number, 2.5, and multiply it out. Case-Shiller index would grow from 71 to 153. And then if we use this methodology, we will predict that by the end of 2023, we would be at 156. Again, this is about less than half of what we had in 2022. So this doesn't quite make sense. Okay, now next one, we have the money supply. Okay, we have money supply growth as well. So how does that look, right? So let's try using the money supply, the liquidity in the economy as a driver to try to explain the home value growth. The table is formatted the same way. I picked this off from the St. Louis Fed chart. This is a very good website. If you guys are interested in number, they have all kinds of data that you can use to and play with. The chart is very flexible. You can add multiple lines. You can plot multiple lines on the same chart with different axes. It's a great website. So we use M1, money supplies, and we again use 2019 as the baseline. Okay, let me fix this year. Okay, so as you scroll, you can still see the year. In fact, I'll make it a little prettier. Put it in the middle. Okay, so using 2019 as baseline, between 2010 to 2019, we had a average annual growth of 9.23%. Wow, that's a huge growth in money supply. Well, that is, of course, because after the real estate bubble burst in 2008, the QE policy from the Fed just injected a lot of liquidity. That is even before the COVID injection, okay, the COVID liquidity injection. So it's a lot. If you look back further from year 2000, it's the annual growth percentage come down to 6.81. If you look at a longer horizon, it's 5.52. So if you use the longest horizon number, we multiply it out, we will get 375. Whoa, okay. So reality, we were at 338. So it looks like this could be the money supply is certainly a factor that helps explain our real estate market growth. Okay, and if we're using the M1 supply number, at the M1 number, we will be at 396, which is, if you take this number, divided by what we have right now, it's 17% from year 2022. Wow, that doesn't make a lot of sense either. Okay, now What else do we have? Okay, another thing we can do is let's take the population growth and plus the CPI and add it together. See what this number comes out to be. So 0.93% plus 2.5%, we were at 3.42% of growth. So if we're using this number and home value growth start from 1991-71 to 2022, we will be at 202. Okay, still quite far off from reality. But actually, if you think about it, the population growth is flawed. Okay, you cannot really use population growth because population growth only represents the demand side. Okay, if you have slow population growth, but if you have even slower supply of housing, okay, so that will actually push the price up. Okay, supply and demand curve. The supply cannot catch up with the demand. Home price will go up. If you have a very high population growth, they have a very high demand, but even a higher supply, price will actually go down. Okay, so you cannot just really use the population growth, right? Just because that's an easy number to find, and it's more of a exercise here. That's I pick a number to go with. I try to look at the supply number and try to create a chart. Plot out the supply and demand curve. That turns out to be a lot more time consuming than what we have time for. So the point of this exercise, yeah, you got to be careful with what kind of data you are playing with. But okay, but if you just take the population plus the CPI, it's sort of, the number seems to be a lot more realistic than just looking at the population growth. Now, okay, so well, certainly home value is a very complex thing. It takes into account of lots of different economic factors. It has to do with the local microeconomy, all of these booms in VCs, in technology sectors in the Bay Area, right? These are things that you don't really need a lot of population to support that kind of growth, okay? As it's evident in the data, we didn't have a lot of population growth, but we have massive amount of wealth created in the Bay Area. And okay, so what else we can look at? Okay, let's collapse some of this. Okay, so what if we just look at the Case-Shiller index itself and trace back, right? So 2019, that's the baseline. If we compare these two over this 28 years, the index almost quadrupled. Okay, it's 3.83 if you take the 2019 number divided by that, and that averaged out to be a 4.91% of growth, of compound growth. And let's take that number and use that as a long-term indicator. Let's say, okay, that is a number that we can rely on in the long term. How much things should grow, right? How much value should grow. For 2022, it turned out to be very close to what we had. It was 3.38. Okay, I'm sorry, 338. Well, this prediction is 314, and if we use this number, we will predict that at the end of 2023 we will be at 330. Okay, so that's pretty close. This is, of course, it's assuming a 4.91% growth rate compound annually, and this does not take into account of the current economic environment. Now, all the things that all this layoff, all of this rate hike by the Fed, it doesn't take into account any of that. It's more of just a long-term trend. Okay, so the trend point it's pointing that, okay, by the end of 2023 we will be at 330, so slightly lower than 338 at the end of 2022. So specifically, it's about what? If we take this number divided by 2022 number, it's about 2.5% below the end of 2022. We are talking about December versus December, okay, which is not really the hottest month of the year, but we have to start with somewhere. So 3%. So this approach just basically tells us, well, you can go down by another 3% to stay with the long-term trend. Of course, it's a long-term trend, and it could go further. But at least we know if value slide down another 3%, it will be consistent with the long-term trend. If you're buying home value, if you're buying real estate at a price below the long-term trend, then what it's saying is, okay, you have very good chance of doing well because you're buying it at a sort of a discount. If you look at the data in long term. The point of this exercise is to give some perspective on the real estate market, and of course, this is very, very primitive analysis. Economists spend way more time; they look at way more data than what we can do in this kind of one hour preparation. And yeah, this is some really simple stuff. But at least the takeaway here is that in the long term, home value is growing somewhere in this 5% per year range, which is higher than the CPI. It's not as high as the money supply growth, but this number can go down drastically or could go up drastically depending on what happened, whether the Fed needs to inject more liquidity. So right now, after COVID, we have a massive amount of liquidity growth. And let's take a look at the balance sheet of the Fed balance sheet right now. Okay, which we reached the top, the peak in this font is really small. I don't know if you guys can see it. It's March 2022. Then it started to shrink a little bit, and then it went back up. So this massive amount of liquidity, it has a long way to come back down, if it ever will. We don't know. So the point being, the liquidity will certainly increase asset prices, okay, but that's gonna move prices. Well, they will allow prices to grow beyond CPI, grow faster than CPI, because we are not looking at money supply that keep pace with CPI. And also, real estate is an asset that you can leverage. You can leverage to purchase. You don't have to, if you're buying $1 million home, you don't need to have $1 million cash. You probably just need $200,000 as a down payment, 20% down, you can buy $1 million home. So that allows people to, compared to stock, compared to other assets, you don't need, you can easily leverage to buy real estate. That gives real estate more fuel, so to speak, to get hot. Okay, another important factor to consider is over time we have more and more asset classes. So not all of this extra money supply go into real estate, or not even proportionally go into real estate, because now we have new asset classes. We have Bitcoin, we have cryptocurrency. So a lot of this money supply actually go there too. Well, I shouldn't say a lot, but a portion. Okay, so not all of this extra money supply is going into the traditional asset classes. We have new ones. So that kind of sort of dilutes the effect of the money supply in real estate. But real estate remains a very favorable, low risk asset class for investors. Okay, so that's it for today. I hope you enjoyed it, and I will see you next time.